Hi folks, welcome to another episode of Who Said What. I'm your host Krishna, and for those of you who are new here, let me quickly set up some context for what this show is about. See, the idea is that I'll pick the most interesting and juiciest comments from business leaders, fund managers, and the likes and contextualize things around them. Now, some of these names might not be familiar, but trust me, they're influential people, and what they say matters a lot because of their experience and background. So I'll make sure to bring a mix. Some names you'll know, some you'll discover, and hopefully it'll give you a wide and useful perspective. Now, for all the sources mentioned in this video, don't forget to check out our newsletter. The link is in the description below. With that out of the way, let me get started. Now, if you've been watching this show for a while, you'll know that we closely listen to what Neelkanth Mishra, the chief economist at Axis Bank, has to say. His readings of India's macroeconomy are really insightful. This week, he gave an interview to CNBC TV18 and we tuned in. This was his blunt take on the economic slowdown in India.
I think the main reason the economy slowed over FY25 was not just the fiscal consolidation that was scheduled, but it was mostly because of the inadvertent monetary tightening. Right. So if your credit growth goes from 16.3% in March 24 to 9.8% in May 25, that's a 6.5% point of slowdown. And given that the system is about 56% of GDP, banking system credit, we're talking about more than a 3% point drag in credit growth. Now, there is bidirectional causality. So slowing economy also drives this. That's a slower credit.
Now think of it like this. Credit is like the water pipes under the city. More than half of India's economy runs through those pipes. If the flow suddenly slows down, the whole city starts to feel it. And that's what happened. It wasn't that people or businesses lost interest in borrowing, it was that policy that tightened the taps. And because it was policy driven, it can also be reversed by policy. That's why he thinks the recent rate cuts and liquidity moves can flip the loop. That is, turning a cycle of low credit and weak growth into one where easier credit boosts demand, which in turn makes people borrow and spend. But don't mistake this for a shift in government's priorities. Mishra is clear that GST cuts are not a big switch towards consumption. As he put it,
see, remember that the fundamental drivers of the economy have not shifted. So you have a one-shot cut
fundamental, I thought, has shifted. No, we were a capex concentrating fisc.
We are still that. So that is the message which I think is absolutely lazy thinking. Because see, the objective of GST reform or the catalyst for GST reform was that compensation cess was ending this year.
Yes.
Constitutionally, it couldn't have been extended beyond FY26. Because of that, then you had some room to cut some rates. The group of ministers recommended cancelling 12%. And then the Honorable Prime Minister decided let's get rid of 28 as well.
So you don't believe you're going from capex to consumption?
0% probability of that, right? Because I think the priority remains to build infrastructure. It will all be, from the government side, it will be primarily supply side interventions.
he was pointing out that this is the point many in the market miss. GST simplification was bound to happen because the compensation cess was ending. The extra money it leaves in the system may boost demand in the short term, but the real story remains the same. This is an investment-led recovery anchored in roads, railways, ports, and power. So where should investors look in this kind of setup? Mishra has a clear pecking order.
I would look at credit providers because when credit growth starts to pick up, it kind of feeds on itself. I would look at construction proxies. I would look at high-value discretionary items. So I would any day prefer cars over FMCG, for example, if I have to play the consumption theme.
His logic is simple. When money starts to flow more freely, lenders benefit first. As government capex rolls out, construction-linked businesses gain. And when households finally feel freer to spend, it shows up in cars and other big-ticket purchases, not soaps or packaged food. In other words, the early action is in credit, cement, steel and autos, not in FMCG shelves. Finally, Mishra points to what needs to change on the policy front. Here, he doesn't mince words.
See, the government has so far, through its fiscal discipline, brought down the cost of capital for entrepreneurs. So a AAA 10-year bond at 7%, AA at 7.2. Cost of equity capital, courtesy folks like Ashish, is already quite low. And now I think that the need is to improve ease of doing business. So all that, Team Lee's RegTech keeps putting out 65,000 regulations, so many filings, so many with criminal penalty.
Yes.
I think all of those need to be brought down, because when you've created this and you have low corporate tax rates and you have, even in FY25, in the BSE 200, operating cash flows, investing cash flows are only 80% of operating cash flows. This was despite significant jump in acquisitions. So the larger firms, while it was initially frustrating to me that why aren't they taking more risk, history says that the incumbents generally try to protect their turf. They don't try to take risk. All the challengers will come from the small and mid caps and, so the smaller firms, which will make use of this environment. To help them grow, I think deregulation has to be among the most important things. That seems to be the government priority as well.
In his telling, India has already fixed a lot of the big macro pieces: lower corporate taxes, cheaper capital, stable inflation. But all that can only take you so far if the regulatory cholesterol keeps clogging the arteries. Simplifying compliance, cutting needless filings, and easing the way for small and mid-sized firms to take risks is what will turn the cycle into something more durable. Mishra sees the slowdown as a policy-made accident, not a structural fault. The revival will be driven by investment, not consumption. When it comes to the AI race, the only thing anyone can say for sure is that the winners of this race are hardly decided. Wang is the founder of AI and cloud unit of Chinese internet giant Alibaba. Recently, he gave Bloomberg his 2 cents on how the race is being run, especially in Silicon Valley.
The only thing you need to do is to get the right person. Not really the expensive person. Because if it's a new business, if it's true innovation, that basically means it's talent. Nobody cares about them. Okay, what happened in Silicon Valley is not the winning formula. That's what I believe,
Now, if you've been seeing the news, US tech companies have been paying through their noses for AI talent. There's a war going for the best AI engineers, with packages crossing even hundreds of millions for single employees. Jian doesn't agree with this strategy though. He says that it's typical of every new wave of technology and it will fade away. In his opinion, what really matters is getting the right person who can learn things on the go, instead of the most expensive person who has a lot of experience.
It's a typical way of doing things. Okay, I will say that.
Now we can say with some certainty that Jian is right. For instance, on the Daily Brief, we have covered Apple in 2 contexts: their attempt to build their own Gen AI and their failure to make a car. In both the situations, they hired the best of the talent who were paid lots of money. Yet, they have not had a mass consumer product to show for it. But this focuses primarily on Silicon Valley. In the same interview, Jian was very appreciative of the Chinese AI ecosystem. When asked why DeepSeek hasn't released their second reasoning model and what that means for Chinese AI, Jian said,
"You can have the very fast iteration of the technology because of this computation. You work fast this time, and then other guy move very fast. And if you're good enough, you can catch it again." I don't think it's brutal, but I think it's a very healthy.
Now, this is a dynamic we have seen time and again with many industries in different countries. More so with AI, because it's really hard to say who is winning or whether it will have a monopoly or many competing players. And the Chinese AI landscape seems to have understood this fact well. But within that landscape, Alibaba itself has turned out to be an incredibly strong player. Its own LLM, Qwen, has already surpassed DeepSeek in various performance benchmarks. Alibaba has also built its own alternative to Nvidia's AI chips. They are complementing this with a push into robotics, announcing a $100 million investment into a Chinese humanoid robot startup just recently. The e-commerce giant is making a strong statement in the entire industry. Now, we have covered the chip race in China before, including AI chips, and we could figure that China still has lots of grounds to cover to match the US. However, it seems like they are inching closer pretty fast day by day. And don't buy our word on this. It's Nvidia founder Jensen Huang who has been most impressed by China. He recently said that our competition in China is really intense. China is right behind us. We are very, very close. Now, it is far too premature to make blanket statements about AI. The race is hardly over. Now, we at Markets are huge fans of Dan Wang. Almost every year for the last many years, he has been writing an annual letter that describes China as it appears from within China. Now, these letters are deeply insightful, helping you understand what China is actually like, shown off propaganda from either direction. Now, over the last couple of years, he seemed to break that streak. But only because this time around he was writing a whole book. We're still waiting to get our hands on it, but in the meanwhile, we're digging through a couple of interviews he gave. One to the New York Times and one for Bloomberg's Odd Lots podcast. Now, both are fascinating if you want to understand China and not just project your own fears and hopes on on the country. To us, one of his key insights into Chinese culture is that it's an engineering state. Starting with Deng Xiaoping, its first leader after Mao, China promoted engineers to the highest ranks of the Communist Party. He contrasts this with US, which he considers a lawyerly society. As he says,
what is really striking about the US is that the founding documents of the Declaration of Independence read almost like a legal argument. Most of the founding fathers were lawyers. And so that's kind of the contrast that I set up, that China is an engineering state trying to build its way out of every problem.
Now, this is a fantastic approach to have if you're building infrastructure.
I was living in Hong Kong, Beijing, and Shanghai, where you can see that these cities get better and better every year. You have new subway stations. Shanghai this year will have 1,000 parks, up from 500 in 2020. All of these cities are really highly functional.
Now, this makes China a great place to live for an average person. And that's not just the case with a giant like Shanghai.
And China's fourth poorest province, I was surprised to see, had much better levels of infrastructure that one could find in much wealthier places in the United States like New York State or California.
But this does backfire, because this is an approach that is not just limited to physical infra. Every problem, no matter what it looks like or what its underlying causes might be, is treated like an engineering project. According to Dan, they treat the mega project as the solution to every problem. Now, these could be economic problems like overcapacity in a sector or social problems like overpopulation. In his words,
because the fundamental problem of China, the most fundamental problem with the engineering state, is that they cannot restrain themselves from being only physical engineers.
That is why, for instance, they tore down large parts of their economy by cracking down on their property and tech sectors.
And I think part of that was trying to funnel China's best and brightest, the people graduating from the top universities, away from building cryptocurrencies or consumer tech and hedge funds into building industries that are more critical to strategic needs, something like semiconductors, aviation, chemistry instead.
But that also means China has many successes. From its mastery over everything from electronics to rare earths, this is at least to some extent a matter of how its economy is engineered. Though it also owes itself to China's incredible enterprises.
I would situate China's success mostly on the level of its fiercely dynamic entrepreneurs.
Now, these entrepreneurs go through a constant trial by fire in a system that we have previously called Hunger Games capitalism. Now, China doesn't have the same sorts of unicorns that the US has, billion-dollar businesses born out of rare stroke of genius. Instead, thousands of Chinese companies go after a single industry in a terrible business brawl until there are just a handful of companies left standing. Now, these victors have process knowledge. After fighting over every single inch of market share, they know how to optimize every bit of their business. As he says,
but let's say, Ross, we give someone who's never cooked a day in his life the most well-equipped kitchen, as well as the most exquisitely detailed recipe. Are we sure that this person will be able to do something as simple as frying an egg for breakfast? I'm not sure if that person will not burn the kitchen down in some big way.
China, on the other hand, behaves like a really experienced chef. It's that sort of implicit understanding of how to make difficult things that really set China apart. And that translates into more production and cheaper goods for everyone. To others, though, it's rough. To Dan,
this is what socialism with Chinese characteristics means, which is a lot of state power, a lot of consumer power, but not very much financial investors' benefit.
And that might ultimately be the downfall of the Chinese system. It's a country that is terrible for investors, terrible for those who own a business, and terrible for its elite overall.
I think this goes to a kind of a broader point within authoritarian systems, which is that no one feels very safe in a lot of authoritarian systems. You can be an elite in Beijing. And what is your life going to be? Your life could be working in the financial industry, which is the definite elite everywhere, including in Beijing. And 2 years ago, Beijing announced that it was going to have a salary cap of $300,000 roughly for people working in state-owned banks. And if you made over that figure last couple of years, you may have to give some money back to the government. Maybe you're working for a tech company and you think that online education is going to be totally safe because Chinese love education and they're always going to be spending more money on their kids. And then that worked until the government declared everything must be a nonprofit. If you're working for the military, if you're working for the government, your life could be subject to either a corruption crackdown or some sort of the political winds changing and your patron is no longer in place.
Chinese elites are incentivized to flee the country because things can go wrong at any moment, and if they do, you won't find anywhere to turn to. But this is no guarantee. Political ideology, Dan warns, is a terrible basis for making predictions about the future.
And I think what is ultimately going to be most important is delivering well for its people. That the country that is going to be able to meet the needs of the people, of its own people, is going to be the more triumphant power.
And this is a game that China bets it can win.
But what the Chinese want to do is to just keep things really, really stable and just wait for the Western countries to collapse.
Now, there's a lot more that we haven't even touched upon. From what Dan thinks about US-China military confrontation to his thoughts on AI to Shanghai's noodle cafes and cocktail bars. We strongly recommend going through both the interviews for more. That's it for this episode. If you have any feedback for me, please let me know in the comments below. GST simplification was bound to happen because the compensation. And when households finally feel freer to spend, and don't buy our own